Most traders lose money because they try to predict the market. Professional traders do something different. They follow the trend. In this video, I will teach you a complete trend following trading strategy. Step by step, with clear rules, real statistics, and proper risk management. Make sure to watch until the end. Let's start with the basics. Trend following means trading in the same direction as the dominant market trend. When the market is going up, we look for buy opportunities. When the market is going down, we look for sell opportunities. We never trade against the trend. This strategy works because financial markets are driven by institutions. Large players create trends, and those trends usually continue longer than most traders expect. Our job is not to predict the market, but to react to it. This strategy is best suited for beginners and intermediate traders. It works very well for swing trading. You can use it in Forex, crypto, and stock markets. Now let's talk about the tools. We will use only two indicators: EMA 50 and EMA 200. This keeps the strategy clean and simple. The best timeframes for this strategy are 1 hour and 4 hour charts. Lower timeframes create noise. Higher timeframes provide cleaner trends. Now let's define the trend. An uptrend exists when price is above the EMA 200. And the EMA 50 is above the EMA 200. A downtrend exists when price is below the EMA 200. And the EMA 50 is below the EMA 200. Very important. We do not trade when the market is ranging. How do we identify a ranging market? If price is moving sideways, EMA 50 and EMA 200 are flat, and price keeps crossing both averages, this is a range. No trades in this condition. Now let's move to entry rules. Buy setup. Price must be above EMA 200. EMA 50 must be above EMA 200. Wait for a pullback toward EMA 50. Enter the trade only after a bullish confirmation candle. Sell setup. Price must be below EMA 200. EMA 50 must be below EMA 200. Wait for a pullback toward EMA 50. Enter after a bearish confirmation candle. Never enter in the middle of a move. Patience is a key part of this strategy. Now let's talk about stop loss. For buy trades, stop loss is placed below the previous swing low. For sell trades, stop loss is placed above the previous swing high. Stop loss placement must be logical, not emotional. Now take profit rules. We use a minimum risk to reward ratio of 1 to 2. This means for every $1 you risk, you aim to make at least $2. You can also trail your stop loss as the trend continues to maximize profits. Risk management is critical. Never risk more than 1 to 2% of your account per trade. This allows you to survive losing trades and stay consistent long term. Now let's talk about performance. Based on backtesting this strategy over 100 trades, the average win rate is approximately 45 to 50%. This may sound low, but because we use a 1 to 2 or higher risk to reward, the strategy remains profitable over time. Remember, you do not need a high win rate to make money. You need discipline and proper risk management. Common mistakes to avoid: trading in ranging markets, entering too early, ignoring stop loss, overtrading. Before we finish, here is a quick reminder. Trend following is not about being right. It is about following the market. Losses are part of the game. Consistency is the goal. If you found this video helpful, make sure to like this video. Subscribe to the channel for more professional trading strategies. And comment below if you want the next video to cover real chart examples and live trade breakdowns. Trade smart. Follow the trend. And protect your capital.